turn to Apple. Show us the money. Let's talk to Rob Searan, columnist for Reuters Breaking Views. All right, Rob, the news today is that Einhorn actually filed this lawsuit against Apple, but what he wants, this preferred stock with a dividend, was actually a plan that he proposed a year ago.
Exactly. A year ago, he said tech companies have all this cash overseas. They're not getting in their bank account. They're not getting any benefit from it. And what he suggests is they issue something called perpetual preferred stock. It's kind of somewhere in between a bond and stock.
Okay.
And what that makes, it means those investors who care about the cash would buy that, and those investors who care about growth would buy the company.
Okay.
And now what Apple came out and said, they issued their proxy, and one of the things they said, well, in names of good corporate governance, we're not going to issue preferred stock, because that's often a way companies do as a poison pill to prevent a takeover. Good corporate governance, the problem is who's going to take over Apple? You know, what company's going to be like, 400 billion, we'll do a hostile takeover. It's not going to happen.
Not happening, yeah.
And so Einhorn said, okay, it's ridiculous that you've got this tool you could use, and you're saying we're not going to use it for good corporate governance, which is ridiculous.
So what do you think of his idea? Because he's saying for every 50 billion in preferred stock, it would amount to $32 a share for shareholders. The math on this, I mean, what do you think about his plan?
It's one of these things that looks really great in a spreadsheet. The problem is it's just so complicated. It's kind of like a Rube Goldberg type of thing.
Yeah.
I mean, maybe it'd work. The easier thing, of course, is for Apple just to increase its dividend. I mean, they've got this cash. They've got all this cash flow coming in. Why not just give more away to shareholders? You don't have to do all these complicated engineering that makes it harder to figure out what Apple is. Right.
Basically, he's just saying, like, you know, we're tired of seeing the stock prices fall. You guys are sitting on a ton of cash. Here's one idea.
It's our money. Give some more back to us. Yeah, exactly.
All right. We should just mention very quickly also that Einhorn is, of course, notoriously known for shorting Green Mountain. He mentioned on CNBC this morning that he is staying short on Green Mountain based on the pretty weak sales outlook that the company gave yesterday in its earnings report. All right, Rob, thank you so much for being with us. I'm going to now turn to Jeroen Martis, our Director of Consumer Research, and we're going to talk us some retail sales, Jeroen. January, so clearances, right, all kinds of discounts and stuff like that, did pretty well despite the fact that people got hit in the pocketbook with that payroll tax.
Very robust numbers, and cold weather had a huge impact on it, especially because it increased demand for the big coats, the warm winter merchandise, which retailers are now selling at a discount because they want to move that merchandise before introducing the new spring merchandise at full price.
So people went out in the cold actually to get their big winter coats.
And they're being very price conscious right now, so they don't want to pay full price, so it's a win-win.
All right, so let's look at some winners and losers, because winners, we have Kohl's, which was a big surprise. Talk to us about that. Macy's, Nordstrom's, Stage Stores, and American Apparel. So tell us about Kohl's.
Well, Kohl's and Stage Stores were the two that benefited the most because of the winter merchandise sale. And as a result, Kohl's posted the strongest result in nearly 3 years, and Stage Stores in nearly a decade. And we also saw Macy's, Ross, and TJX all increase their earnings guidance for the fourth quarter. So very well for the month of January.
I have a Kohl's near me. I guess I should have gone out and hit the sales there. Yes. All right, the losers, Cato, Wet Seal, The Buckle, Fred, and Bon-Ton. I feel like you and I, Wet Seal and The Buckle, they're on the losers list a lot.
Well, you know, those two teen retailers don't get it right in terms of fashion, and teenagers are very, very fickle. They want to have the right merchandise.
So they have not been getting it right there. All right, Jeroen, thank you so much. I'm going to now move to the hot spot. And as I do, remember those snaps at the bottom of your screen for more headlines of the day. Greg Roumeliotis is here. He's our PE guy, and he's going to talk to us about actually the merger deal. They're in final talk, supposedly, right? American Airlines in bankruptcy and U.S. Air for this merger. And it seems like right now the devil's just in the details.
That's it. I mean, the contours of the deal have emerged for a while, so we knew that it's widely expected that U.S. Air's CEO will be in charge overall in a merged airline. We knew the rough ownership structure that U.S. Air shareholders are going to own about 30% of the company, and AMR's creditors will own about 70%. So, and crucially, AMR's unions are supportive of this. So it's not a done deal, and negotiation could collapse. We're much closer now.
Board seats still to be worked out, I guess. Yeah. I mean, perhaps, so this is going to make this company the largest U.S. airline, I think, by traffic in this country. I mean, perhaps we'll see, you know, fares continue to go up. I mean, they're saying that maybe that money's going to go into better customer service or better frequent flyer plans. Airlines, you know, God love them, not necessarily known for great customer service. But
that's right. Well, we're going to go from 5 major airlines to 4. They're going to overtake Continental, and it's going to be them, you know, Southwest and kind of like Delta. And we have to hope that this doesn't translate into kind of like higher prices, but it does mean better customer service.
Right. All right, Greg, talk to us about KKR, because they had in their earnings the strongest quarter as a public company. And this is basically cashing out on a bunch of investments, right?
Yeah, exactly. So equity markets, debt market have been like really strong, and that has allowed private equity firms to cash in on many of their investments. Their shares have been down a little bit this morning. I think
people down about 3%. So explain that.
I think people may have focused on the boring bit, which is meant to be predictable. So their fee-related earnings, basically fees they get not for performance, but just for basically managing assets. There are some transaction fees that they get for when they invest in companies. They get those fees from their portfolio companies they buy.
Right.
And revenue from that is down because they've been investing less, actually. They've been quite disciplined. That's what they would say. So though they've been selling more stuff, they haven't been making many private equity investments, and that's been the result of that.
Gotcha. Okay, so we've had a bunch of earnings out from these PE firms. Tomorrow, Apollo Global, what do you see there?
Yeah, so Blackstone has already reported, and they've done really well.
Yeah.
Apollo reporting tomorrow. What's interesting about Apollo, now they're more of a credit investment firm rather than a private equity firm, just based on their assets under management. And of course, on the credit side, you know, the debt markets have been really hot because people are looking for yield with interest rates so low. So we have to see how their structured products are doing, those CLOs, those complex kind of like credit products, but also kind of like on the distress rescue lending side, how they're doing, because maybe there are like fewer opportunities now, given that the economy is recovering.
Right. All right. Look for that tomorrow. Greg, thank you so much. Remember, everybody, follow us on Twitter at Reuters Insider and get more great videos at Reuters.com/ReutersTV. I'm Lisa Bernhard. This is Reuters.